Welcome to the Explainer. You know, every time a company announces these massive, record-breaking sales figures, there's a single global rulebook that decides if that number is even real. Today, we're going to dive into the story of IFRS 15, the standard that literally changed how the entire world counts its money. It all boils down to this one seemingly simple question: when is a sale really a sale? I mean, for huge global companies, this used to be a shockingly complicated thing to answer. Was it when the cash hit the bank, when a contract was signed, or maybe only after the customer was totally happy? Getting this wrong wasn't just a small mistake. It could seriously mislead investors and hide some really big problems. So to really get why this new rule was so incredibly necessary, we have to take a look back at just how broken the old system was. For decades, reporting revenue was, well, it was a mess. It was a confusing patchwork of different rules that changed from one industry to the next. Just look at how specific and fragmented these old rules were. You had one for construction, a different one for real estate, a whole separate one for customer loyalty programs. It was like a quilt of patches sewn together over 20 years. And what that meant was you could barely compare the performance of two companies, even if they were in the exact same business. It was chaos. So in 2014, regulators decided to just wipe the slate clean. They introduced IFRS 15, and it replaced that entire messy collection of rules with one single powerful core principle. One idea designed to work for any company in any industry, anywhere in the world. And this is the hero of our story right here. This single idea cuts through all that old complexity. Let's translate it from accounting speak. It basically says you can only recognize revenue when you've actually transferred a promised good or service to a customer. And the amount you recognize is what you genuinely expect to get paid. So it's not about when the cash arrives, it's all about when the value is actually transferred. To build this new framework, the standard had to start with the absolute basics. First things first, what even is a customer? Well, it's not just anyone who gives you money, it's a specific party you have an actual contract with. And what about the contract itself? Now, this is crucial. A contract doesn't have to be a fancy 50-page document full of legalese. It can be a verbal agreement or even just implied by how you normally do business, as long as it creates real, enforceable obligations for everyone involved. Okay, so we have this powerful core principle, but how does it actually work in the real world? Well, it's all built around a practical, logical, 5-step model that every single company has to follow to answer that original question: when is a sale really a sale? This 5-step model is the absolute heart of IFRS 15. It takes something that could be really subjective and turns it into a clear, step-by-step journey. Every company that reports under IFRS has to walk through these exact 5 steps, no exceptions. All right, step 1, identify the contract. This is about making sure a real, legitimate agreement actually exists. It has to have clear terms and a real commitment from both sides. And here's the kicker: the company has to be pretty darn sure that it's probable they'll actually collect the money. You can't book revenue based on a hope and a prayer. Next up, step 2. The company has to break the contract down into all its individual promises. Just think about your cell phone contract for a second. You're not just buying one generic phone service, right? You're buying a physical handset and a monthly data plan. IFRS 15 forces companies to identify each of those distinct promises, or what it calls performance obligations. Step 3 is all about figuring out the transaction price. And this isn't just the number on the price tag. It's the total amount a company truly expects to receive after you factor in all the variables. Things like potential returns, volume discounts, or maybe even performance bonuses. So for step 4, you take that total price you just figured out, and you have to slice it up. You allocate that price across all those separate promises you identified back in step 2. So for your phone contract, the company has to decide how much of your monthly bill is paying for the handset versus how much is paying for the data plan, based on what each would cost on its own. And finally, we get to step 5, the moment of truth, recognizing the revenue. This is where it all comes together. A company can only book that revenue when it fulfills its promise by transferring control of the good or service to the customer. For the phone, that's the moment you walk out of the store with it. But for the data plan, that revenue is recognized bit by bit, month after month, as the service is actually delivered to you. Okay, so that final step, transferring control, it brings up a really critical question. Is a promise fulfilled all at once, in a single moment, or does it happen gradually over a period of time? Getting this distinction right is absolutely fundamental to timing your revenue correctly. Luckily, IFRS 15 gives us a clear checklist to figure this out. Revenue gets recognized over time if the customer is getting and using the benefit as the work is being done. Think about a Netflix subscription or a monthly cleaning service. If it doesn't meet those over time rules, then it's recognized at a point in time. That's the single moment when control is officially handed over, which is usually signaled by things like having legal title or physical possession. So you might be thinking, okay, it's an accounting standard. Why should I really care about this? Well, you should care, because behind every single revenue number you see in the news, there's this rigorous 5-step process. And its impact on the business world is just huge. So what's the real big picture impact here? This isn't just a rule for accountants hiding in a back office. It's a common language for global business. It means for the first time, we can actually compare a software company in Germany to a construction firm in Japan, apples to apples. It forces companies to be transparent, to show their work. And ultimately, what does all that do? It builds the trust that our entire global financial system is built on.
So the next time you see a headline shouting about a company's record-breaking sales, you'll know what's really behind that number. It's not just a figure they pulled out of thin air. It's the result of a rigorous 5-step story, a story about contracts and promises and the transfer of value. And it makes you wonder, doesn't it? How many stories of success might look a little different once you know exactly how the score is being kept? Thanks for joining us.